Before we kick off today's episode of Macro Mondays, if you would like to take your trading career to the next level, Onyx Institute, my online trading course where you can learn fundamental and technical analysis of both the energy and financial markets, will be live and available for you to sign up and watch from next month. So please keep a lookout for that at onyxcapitalgroup.com. And if you have any questions or queries, you can email me at onyxlnd@onyxcapitalgroup.com. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
Plenty to talk about after last week's tariff announcements by Trump. Equity markets sold off really hard on Friday in the US. We've had a collapse in Asia this morning. Asian equities have had their biggest one-day loss since the financial crisis in 2007, and the Hang Seng's had its biggest one-day loss since 1997.
In commodities, we see that Brent has had a 15% decline over the past 4 days. We'll also look at how gold's momentum is flagging somewhat as people are forced to liquidate on their profitable longs. We're going to be looking at how this in commodities and in all asset classes is going to play out over the week ahead.
And just to let you know, we will be posting daily global macro updates on our LinkedIn page, Onyx Institute. So let's look straight at the asset market's reaction to Trump's tariffs. We saw the biggest volume of all time on Friday on New York stock exchanges. You can see that from the chart there. What's interesting though is while hedge funds had their biggest one-day selling since 2010, retail investors had their largest buying since in 10 years. That's from data from JP Morgan. Retail investors bought 4.7 billion worth of equities on Friday. Also, retail investors' net inflows into US ETFs hit a record in March in a single month of $40 billion, 10 billion higher than previous all-time high posted in 2022. This morning, we've seen circuit breakers in Japan. The Nikkei market has been forced to close because of extreme sell-offs. We've had the Chinese Beijing exchange down 20% today. We have the US markets opening in under 2 hours, and a fair chance right now they're posting losses of 5%. A fair chance that they will have circuit breakers where the markets automatically shut when they're down 7%.
Yeah, I think Taiwan also had a circuit breaker on their exchange. It's been doom and gloom. I think a lot of people were uncertain whether the devastating momentum of Thursday and Friday would be carried on over the weekend or whether hysteria would settle. But it seems, Asia really set the tone this morning. Japan, things were off, first thing down, up to sort of 12, 13%. When Europe opened, the DAX was down 10%. So this awful momentum, especially in equities, has been absolutely carried on straight away. And, it's particularly interesting what you're saying here about the retail buying and hedge funds selling. Retail buying, it's not fair to say that it's dumb money, but I think a lot of people who had a fear of missing out over the amazing equity moves over sort of 2023, 2024 might be looking at this as my time to get into the Magnificent Seven, to get into big tech in the US, to jump on board that momentum. But I think there's still a bit of a shakeout going on here, and perhaps a lot of the retail guys might be stopped out before they've even started.
Absolutely. We mentioned last week that CTAs, so trend following algorithms, were already $30 billion short the market. So the trend was already down, and the market was hoping some good news over the weekend. In fact, on Friday, Donald Trump called on the Federal Reserve to cut rates. The Fed said nothing. Their next meeting is on May 7th. So we have a month till then. It's just bad news.
Yeah, I think the image as well, whilst markets are closed over the weekend, journalists are very much open and working. And there's been a huge amount of analysis done, which really looks to undermine the decision-making behind these tariffs. Many journalists correctly pointing out that things seem arbitrary. And I don't want to jump the gun here. And I think let's definitely spend time to analyze these properly. But whilst the markets have been closed, I think a lot of consumer confidence has inherently been wiped out over the weekend. And so we've come in on Monday morning and that poor consumer confidence has been immediately reflected in the markets.
Yeah, consumer spending is 70% of GDP, so this would be a big hit. And when we talk about the tariffs, it's also going to be the reaction to the tariffs. So what we've had already now is several countries have said they're going to drop all tariffs on the US. We've had Taiwan, Israel, India, Vietnam, and Cambodia. So it's a choice of what do countries do? Do they de-escalate and drop tariffs? Do they wait and see, or do they retaliate? And what we've seen with China, of course, is they've retaliated with 34% tariffs against the US. And they've also had put export restrictions on certain rare earths, which is a big hit to electric vehicle production, particularly batteries.
I think looking at China as well, if you sort of scrutinize the language used when they were announcing these 34% tariffs and what they've been saying subsequently, they're accusing the US of economic bullying, political bullying, very pointed language. And I think they're seeing this as almost an opportunity to go toe-to-toe and take the US into the boxing ring, perhaps. And there are going to be more and more meetings between China and some of their trading partners to try and undermine the US here. And this could be a real seminal moment in the geopolitical makeup and the economic makeup of the world going forward.
Absolutely. And what they've done in China as well, rather than de-escalate, they've gone head to head. And this morning, you can see the chart here of the Hang Seng Tech Index, which was down at the time 14%. But what the Chinese have done is they've started to step in and stabilize the market. So you're seeing government support in the equity markets there. So a big, basically head to head here with the US. If I bring up the chart here of the Nasdaq, this is Friday's close. You can see here the Nasdaq's broken key support. It's now down 25% from the all-time highs. Again, it's fairly arbitrary, but it's called a bear market when it's down 20%. We've got Bitcoin down 25% from the highs. We've got the VIX volatility index touching 60. Pretty big moves. And with the S&P, that's just entered a bear market. You can see the chart here. This is the future. So this incorporates today's pre-market, and you can see that's going to open down. Again, when I last looked, it's looking to open 5% down. A bit of a rally coming in there, but there's a chance we see circuit breakers today. If the market goes down 7%, it automatically stops for 15 minutes. It reopens. If it's down 13%, you see another 15-minute circuit breaker. If it goes down 20%, the market shuts for the day. But some charts I was already looking at earlier last week. The market's already expecting US equities to fall, but retail investors are not pricing, they're not selling with it. So here is their stock allocation is the red line, and bull bear sentiment from retail, from investors. So although people think the market's expensive, they think it's going down, they weren't positioned, and as we just said, they're actually buying into it. So that we haven't seen any retail capitulation yet.
Yeah, it's a really curious picture, and I guess it comes down to the individual every time whether they like the risk at these levels, etc. Are they seeing these equities being absolutely decimated and thinking, well, for the entirety of my life and my parents' lifetimes, equities have basically just gone up, and any move down, well, I remember moves down in COVID and that bounced back. I remember, it's almost like forgetting the pain of childbirth, that thing that's often sort of cited. People forget the pain of even 2008, and they look at the mid 2010s as, in the US and in Britain as sort of fantastic bull markets.
In fact, there wasn't equity capitulation during COVID. The market sold off, but before we saw capitulation, the Fed came in with huge stimulus. But if you go back to financial crisis, that's now 2007, that's 18 years ago.
Yeah.
Equities in the US fell nearly 50%. And if you go back to the 2000, then the Nasdaq sold off over 80%.
I think, it's easy for people to sort of see the pain that they're taking and just think, oh, well, I'll ride it out and I'll hold it. But for any retail trader looking at this, you sort of have to be immediately thinking, oh, is this a good level to be getting in at? Should I wait another I mean, perhaps even just a matter of like 6-12 hours or so before, things come in. If you're waiting here until the US opens, you would expect to see a sell-off, and immediately you're going to be seeing, your equities being 5% cheaper than perhaps they would have been if you were to purchase right now. So
yeah, perfect to de-risk and buy when the market's going up rather than adding to markets when it's going down. A similar chart highlighting the same correlations here between consumer sentiment. This is from the University of Michigan Consumer Sentiment, and AAII asset allocation equity exposure. Again, the market's pessimistic, or consumers are pessimistic, but they're still long of assets. Again, history tells people that it's buy and hold, but again, these sell-offs typically don't recover within 24, 48 hours. I think there's plenty more time for this to play out. And the tariffs are going to have an impact on the economy for sure. And as we'll see in a second, the data is starting to turn, or has already been turning since Trump really took office.
Yeah, I suppose one of the key questions when it comes to the impacts of the tariffs and obviously the equity sell-off we're seeing now is the sell-off in equities, proportional to the economic damage that tariffs are going to be doing? And in my opinion, it's overly represented. The sell-off in equities, what we're seeing and what we're going to be seeing, is going to be amplifying most certainly, the actual economic significance of these tariffs. These tariffs are bad and recessionary and inflationary. But fundamentally, I think what we're seeing is an equities market where there has been a bubble and things have been overextended. And this is probably going to be quite a significant rebalancing and redressing of things here.
So it's a chance for prices to get back to normal.
Yeah.
As opposed to calling it a crash.
Exactly. And if you look at sort of how price to earnings ratios have been, particularly in the tech center, as we had the Mag 7 chart showing that it was sort of like one of these thought park rides where it just falls off an absolute cliff. But price to earnings ratios have been out of whack for a while. We've been reporting it on Macro Mondays, and if we're in on it that things have been overextended, then a lot of the market will be as well. So yeah, I think this is a reassessment for much of the equity market here.
And of course, the key at the end of the day is the price action and where the price is. So we'll look at a couple more charts and then we'll discuss where we think this goes over the next few weeks. Firstly, the US 2-year, you can see here that's broken key support around the 350 level. Actually, as I say that, it's bouncing around there as we speak. The market's trying to find its feet a little bit. When you get aggressive sell-offs, as aggressive as we've seen, you will get bounces on headlines and then typically more selling comes in. The 2 years sold off, 350 is a key level on that. And the 2-year more reflects what the Fed will be doing. Last week, we discussed that the overnight index swap was pricing in 92 basis points of cuts over the next year. That has suddenly jumped over the last week to 133 basis points of cuts over the next 12 months. And the market's pricing in 50% chance they cut on the 7th of May, the next meeting. Looking at the 10-year, you can see that's also broken a key support, 410, clearly broken there. Technical analysts would call that a head and shoulders pattern. Next target would be 3.6%. Important point to talk about though, technical analysis can be less effective when markets are, you're seeing just blind panic selling. We're discussing what was happening in the office on Friday. Markets were gapping. People are just trying to hit prices, just trying to unwind positions. What's interesting though, if we look at the 2s, 10s curve, so the difference between the 2-year and the 10-year, that is now steepening. Of course, yields are going down quicker at the front as the market's pricing Fed cuts. Key level, 43 basis points. It's just breaking through that. I'd expect the market to keep steepening here. One more chart, the dollar yen. Here's a long-term trend line, comes in at 145, the figure. Markets, again, bouncing around that, waiting for the US to come in. Interesting to see if that 145 level breaks, then I'd expect to see further aggressive capitulation to the downside.
Is there any real surprise that the dollar's weakening versus the yen here? I don't think so. I mean, it sounds all, in terms of the yield curve, everything seems terrible. Trump asking for the Fed cut rates. This all seems pretty damning for the greenback.
Absolutely. And typical risk-off selling and buying of yen.
Yeah.
So how do you think this plays out in the next week or months?
I mean, yeah, I think we are seeing, this is a good time to be dramatic and actually think to the downside and think to worst case scenarios, because this is a real step away from the WTO principles, the sort of Washington consensus, as it was initially dubbed, that the US was such a big proponent of through, basically from post-war 1945 onwards. The US has been, this huge advocate of free trade, and it's just wiped all of that out over the weekend or over the previous week. So I think it's, not a bad idea to start actually stress testing various scenarios. One particular scenario is the complete failure of, the dollar-denominated world that we live in. I think the dollar is going to be devalued a huge amount. People are going to be exporting, less to the US. There's going to be retaliatory tariffs coming in left, right, and centre. There's going to be less dollar demand. With lower interest rates, there's going to be more protectionism and less hot money flows going into the dollar. So I think the dollar will be depreciated a huge amount. You're going to be seeing less confidence in the dollar, well, partially due to less demand, but also because the confidence in the US government is going to be waning significantly after such a dramatic announcement, and the style of the announcement as well. So yeah, the US hegemony, not only sort of in terms of trade worldwide, but in terms of the role of its currency, I see that as waning significantly over the next week, month, year, unless there's a complete volte-face and turning of face.
I think there's also a lot of pressure going to be on Trump because they have the midterms. Consumer confidence is going to get hit with this, and also his team. Lutnick's under a lot of pressure at the moment. Elon Musk's apparently taking more of a backward seat, and Scott Bessent, Treasury Secretary, apparently he's not been part of this. He's got a great track record as an investor, so there'll be a lot of pressure on them, and Trump doesn't want to back down. Yeah,
a few British journalists and political commentators have made the point, which I think is probably a miscomparison, but have made the point that this might be Trump's Liz Truss moment. These, the similarities are that the political head being, Liz Truss at the time, Prime Minister of the UK, Trump obviously now President of the US, made economic announcements that are completely founded in ideology and principle. With Liz Truss, it was actually the opposite. It was going to sort of free trade and small government. With Trump, we're seeing, a very protectionist and anti-free trade approach. But these are huge sweeping changes that are very costly in terms of voter goodwill, political goodwill, and I think if he didn't have this sort of cult of personality, if he didn't have this zeitgeist that mean that some people will support him till the cows come home, he would, if he'd have been in the UK, he would have been gone by now, I would have thought.
And there'd be a lettuce on the front of the newspapers.
Oh, absolutely. And it would have, been replaced by now, I'm sure. And, but, he does have this hardline, unwavering support. So I doubt he's going to lose his sort of actual position in any time soon, and he will be there for the midterms. But when the midterms come in, if there's just unmitigated inflation, consumer confidence through the floor, the Republicans will lose any majorities that they have without a doubt.
Also, his game theory and his art of the trade, art of the deal, if he wants to back out of this, the easiest way will be to fire someone. That's not going to look good for the team. But also it's a relationship with the Federal Reserve. This will be inflationary. That's their focus. Of course, they will act if growth is going to be hit substantially, but they don't want to act because Donald Trump's telling them to.
Yeah.
So I'd be very surprised, unless the markets do completely crash, if they were to have an intermeeting move. And intermeeting moves used to be common. I remember them happening in 2000, showing my age here. With the Nasdaq, they happened, of course, with COVID, but the Fed won't want to be reacting to Donald Trump shouting at them. So before we come to a few more charts, let's look at a bit of the data last week. The data was pretty secondary. First of all, we had weak US data, weak ISM data, Institute of Supply Chain Managers, for both manufacturing and services. This came out weaker than expected. Again, this is the Fusion Index, so above 50 shows expansion and below 50 contraction. Manufacturing fell back into contraction at 49.0, last at 50.3. It was worse news behind that though. New orders were at 45.2, employment at 44.7. The only high number was the worst of a lot. Prices paid, the one you don't want to be high, came in at 69.4, the highest since June 2022. Again, this is manufacturing in the US. That's about 1/3 of the service sector, but it's manufacturing that Donald Trump's particularly trying to revive. If we look at the ISM data for March, that came in at 50.8. Slight expansion was expected to come in at 53.0. It's back at the lowest level since the pandemic, and that was the fourth largest month-on-month decrease on record. And then to the jobs data, we had payrolls come out on Friday. Well, despite weak employment data within the ISMs, the non-farm payroll beat expectations, coming in up 228,000, but the wage growth was worse than expected. The unemployment rate rose to 4.2. And the number of people holding multiple jobs has gone to another highest level since 2009. What we also saw last week, though, the downside news for employment, challenger job cuts came in much higher than expected. 275,000 jobs cut from 172,000 previously. And the March jobs cuts was the highest level since March 2020. So the data looks like we're going to see weaker payrolls going ahead. Certainly ISM data is weaker than expected. And we're also seeing US bankruptcies are rising. And that's even before the tariff Trump tantrum of last week. So there's sort of bad news baked into the US economy here. And this is just going to exacerbate the pain.
No, it's fully, it's a bad situation. The jobs market is poor in the US, bankruptcies are high, and as you say, looking forward, it seems as though this is only going to get worse as people are, having to work multiple jobs, getting paid relatively less. Prices of goods are going to be increased because of these tariffs. There's just going to be worse and worse demand, more and more unemployment. It's dire. It is absolutely dire. And of course, one of the aims of these tariffs is to increase manufacturing in the US and bring jobs back to the US. But that I can't really see that working in the same way that, perhaps it would have done in the 70s and 80s. When Trump was giving his tariff speech, he got one of the former Detroit automobile manufacturing workers up on the stage. Manufacturing jobs in the car sector, for instance, whether that's going abroad or at home, you're seeing technological improvements that will replace humans, etc. The old industries that you could rely on to provide jobs, you can't anymore. So unless Trump, also wants to introduce bans on certain forms of technology in order to increase employment, then, you're not going to be seeing an employment increase. And if he were to do anything as stupid as that, then you're seeing a huge fall in productivity. So it's lose-lose here for the US.
Absolutely. And the unemployment rate at 4.2, that's not a particularly bad level. The cycle low, as I seem to remember, 3.4. So now it's at 4.2, but it's trending the wrong way. It is trending up. Credit spreads are breaking higher. We reported on this last week. We saw the first signs literally on Thursday, a week and a half ago. That's a new dynamic to the market. The equities have been selling off for several weeks, but now credit's getting involved here. This is showing that risk-off mentality is really starting to hit all markets. Bit of news out of Europe. German CPI came in below expectations. Again, one thing, if China's not going to be exporting as much to the US, then there's a fair chance they'll end up dumping it in other countries. Typically, Eurozone will be a hotspot for that, and we could see certainly more disinflation or even perhaps deflation there. But while we're on Germany, the recession in Germany is getting worse. 2.92 million people are unemployed in Germany. That's the most since June 2020. Second highest level in 11 years. Unemployment has risen to 6.3%. Highest level since 2020. So CPI is falling, but unemployment is going up. We did see consumer confidence or business confidence pick up in Germany, probably off the back of the new stimulus agreement. Public sector wages have gone up a staggering 5.8%. And German industrial production just came out this morning, fell 1.3% in February. Far steeper decline than expected. Interesting chart I pulled up here, though, is the euro against the Aussie. Euro's been seen actually as a bit of a safe haven currency. Typically yen, Swissy are safe havens, and the dollar, but the dollar's obviously suffering in the environment we've discussed. But Aussie's doing particularly badly. So again, here you've seen a big move higher in euro Aussie.
Yeah, whilst we're on the topic of Germany, I just want to sort of pull everyone's attention to the European stocks that we saw open a lot lower this morning. So the DAX opened 10% lower this morning, and it actually recovered somewhat. But I think the European Union economies and European economies full stop, if you sort of look especially at countries like Switzerland, obviously non-EU, but these countries are going to be so significantly impacted by these tariffs and almost at arbitrary rates. So I sort of wanted to point out a bit of the stupidity and hypocrisy of the new tariff rates here by doing a bit of a deeper dive. So if we look immediately at the trade balances, the US has imposed tariffs based on the trade imbalance in goods that it has been facing. You know, they've tried to make it more fancy by including the denominators price elasticity of import demand, which they set to equal 4, and the tariffs pass through to retail prices rate of a quarter. So of course we saw 4 multiplied by a quarter equals 1. So we saw the tariff rate that they calculated just being the net trade balance, trade deficit in goods. If you look at a lot of these European economies, whilst they have a trade balance surplus to the US, i.e. in goods, they are exporting more in terms of value to the US than the US are, than they are purchasing from the US. If you look at goods and services combined, they actually are net importers of US services and become, you know, their overall trade deficit becomes positive. They do have a trade deficit with the US. So if you look at the example of Switzerland here, we see on this chart, if you were to include goods and services, they would have a new lower tariff rate of just 10%. The European Union overall would have a trade deficit of 20%, which would become 10%. So European economies are being overly penalized by these tariffs and the import on goods. Off the same bat, you have countries like Bermuda that have been practicing sort of non-competitive policies in order to make their financial services more competitive. i.e. they've been having lower corporation tax than, you know, would be feasible in the US. So they've been net exporters of financial services and services full stop to the US. And whilst they are importing US goods, so on this goods trade balance, they're importing more, and so they're not being penalized with a high tariff rate. They're getting the bottom line 10%. If you were to include services as well, they ought to be increased. They ought to be sort of sanctioned with a higher tariff rate. So it just seems totally arbitrary how the US have gone about this. And I think, yeah, looking at it as well on a year-on-year basis, countries are just being targeted based on 2024 as opposed to previous sort of 2020 to 2023 timeframes. So, for instance, the US versus Saudi Arabia had a positive trade balance in 2024 that was negative in 2023. And it was the other way around with Bolivia in 2024 versus 2023. 2024 having a trade deficit, 2023 having a trade surplus. So yeah, this has been entirely arbitrary by the US, really ill thought through. And I think this is one of the big reasons why confidence in the US economy has just gone through the absolute gutter over the week.
And it's not just how arbitrary it's done, it's how Donald Trump's taken a baseball bat approach as opposed to negotiation and discussion.
Yeah, it's scorched earth.
Yeah, absolutely. Bring up another chart here, sterling yen. Again, yen is being seen as a bit of a safe haven here. That's breaking down quite aggressively. Next support's broken through 188. Next support's down at 180. Remember this after COVID and also during the financial crisis got down to 120, even below 120, about 116. So again, if yields keep going lower, then expect the cross yen currencies to keep falling as well with it. On to Brent, that pretty aggressively broke the key 69 support level we were discussing last week. I was out the office, you were in on Friday, crazy day.
Yeah, it was carnage. We've seen, I think it sort of hit lows of the $61 per barrel handles, the June Brent future. This is from Tuesday or Wednesday's high of about $75 per barrel. So it's been a huge notional sell-off in crude prices. In the product markets, things have occasionally been less affected. So in gasoline, for instance, European gasoline remains relatively in relatively high demand. This has been seen as a futures move, which I think you can look at managed money. Hedge funds had taken their all-time lowest amount of long positions. We've been discussing this on Brent. And so seeing this selling has been absolutely delightful, I'm sure, to many hedge funds. But yeah, it's going to be a very curious picture because it's understandable that with macroeconomic risk, people look to futures, they look to oil, and they say, well, if we're going to be entering a recession, there's going to be less outright demand for oil. But fundamentally, elasticity of demand for oil products is going to be, relatively rigid in comparison to other products. And particularly, I think if you were to look at the electric vehicle market, electric vehicles, a new electric vehicle costs, if it's a BYD one, it's still going to be sort of $20,000. A new Tesla would cost anywhere between $30,000 and $100,000. These are significant expenses that people are going to have to front if they want to get an electric vehicle. And with consumer confidence being so low, you're going to be seeing less substitution to these more expensive but less oil dependent alternatives. So I think you're going to be seeing some really sticky purchasing of cheap oil-based solutions to everyday problems. So I don't see the oil price fundamentally having to come off that much from here. What we did see was, a bearish headline from OPEC saying they're going to raise production in May by more than expected. This was up to, far beyond what people had previously priced in. So there are factors that are keeping a lid on the Brent price here, macroeconomic and OPEC factors. But I see the Brent, futures level as having a bit of support around here. Now, I would say, obviously, it's worth looking at a chart here, and we've got from Onyx Markets, which is the platform that you can go and trade Brent futures on. If you completely disagree with what I'm saying and think that, demand for oil products is only going one way and that's going to go down and demand for Brent's going to go down, well, you can go and put your position on Onyx Markets here, where you can see that we've got the Brent flat price chart. You can see the indicators in the Bollinger Bands here that show you that, for good parts of last week, we were hitting through the lower bands of the Bollinger Band and it still kept going down. So, I think it's really worth going and trying to apply your own critical thinking and putting a trade on here.
Interesting point to note as well. We discussed how volatility we've been so low in oil, in Brent price for over a year, how 69 was such a big level. But when volatility is so low, it means traders can take bigger positions because their VAR limits is based on historical vol. The problem with that, though, is when stops are triggered, you get bigger moves because they have bigger positions to unwind. Hence the huge move we've seen.
Yeah.
If we look at copper, even bigger moves. You can see here copper. This is more to do with, again, just straight global growth concerns, but you can see over the course of 3 trading sessions, a huge move lower. Again, that's a commodity that's traded much more actively. What we've seen, for instance, iron ore, there's less proprietary risk in iron ore. That's had a very shallow move over the last few days, down just 1.4% when I last looked at that one. But much more proprietary risk and positioning in copper. And you can see huge move across all markets. Gold is another interesting one. Typically, when we see this risk-off scenario, you'd see money flow into gold, but gold actually sold off at the end of last week, basically because funds are forced to liquidate their profitable positions to offset losses in other markets. So we saw gold sell off aggressively. Support is at 2,954. Resistance is at the highs 3,167. As hedge funds are reducing risk and offsetting losses, then I'd start to see money coming back in. This is a typical risk-off trade and longer term buy gold.
Yeah, I think the trading environment around this is definitely key to look at, though, because all signs are pointing to gold being supported. Inflation's going to be high. Gold is a good inflation investment and a good inflation trade. But as you say, if people are, losing on so many other positions, whether it be equities or other commodities such as copper or crude length, then gold is not going to be supported. And I think I always find it interesting when we talk about the all-time highs in silver, where silver broke out to the upside, but then people who were long had to stop out of their length because the volatility had increased and their risk managers said,
margin calls from the exchanges.
Exactly.
Yeah.
So people were margin called on winning positions. And so it's sort of not an unfair comparison to look at this supported gold level and be sort of scratching your head a bit thinking, why is this momentum not carrying on? This is anti-US dollar. This is anti-inflation. This is the perfect trade right now. But of course, prices are having a lid kept on them because of the net length having to be liquidated to keep people solvent.
Yeah, when markets are panicking, it's all about your positioning.
Yeah.
And then once you're out your positioning, then you can start thinking about adding risk again. One last chart, Bitcoin, again, typically seen as, or supposed to be seen as a risk-off trade, insurance against, well, everything, inflation, it was going to the moon, everything's supposed to be supporting it. But clearly, as we highlighted last week, it's just highly correlated with equities. There's a lot of proprietary risk gone into it, and you can see that fell hard again this morning. It fell 11% over the weekend after the New York Stock Exchange closed, which is typically seen as a good barometer of how the markets are going to open on Monday morning in New Zealand or Sunday night, as that is in the US. But here you can see it bounced off support at 73,900. Again, it'd be interesting to see if that level holds. Clearly, some shorts have taken profit on that. Some new money came in to buy the dip there. But again, there'll be significant stops just below that 73,900 level. If they get triggered, then there'll be another wave lower. But the high in Bitcoin, 101,000. So we've seen just over 25% sell off from the peak. So what's the market pricing for central banks? The overnight index swap. We mentioned earlier, the Fed, it's pricing in 5 cuts over the next year, 133 basis points, just over 5. 50% chance they go on the 7th of May. Again, if equities sell off from here, that will just go up. ECB markets looking for a full 25 basis point move on the 17th of April. Bank of England, full 25 priced in for the 8th of May. Australia and New Zealand have priced more cuts aggressively. Interesting one, the Swiss franc. The market's now expecting Swiss rates to go negative and the Swiss base rate to be at minus 33 basis points in a year's time.
Crazy.
And finally, Japan, the market was pricing 30 basis points of hikes. That's getting unwound. The central bank, BOJ, won't want to be hiking at all in this environment. On to this week's data. This week's data is largely going to be irrelevant, but what's coming out anyway? Tuesday, Australian consumer and business confidence. Wednesday, US mortgage applications, and the Fed minutes from the last Fed meeting. Again, completely irrelevant now. US CPI on Thursday, some Chinese inflation data. US PPI on Friday, Michigan consumer sentiment, and UK industrial production. So just to highlight again, we are posting daily morning updates about the markets on our LinkedIn page at Onyx Institute. It's going to be a crazy week.
Yeah, and as you say, I think a lot of the data releases coming out will be, they're not going to be completely irrelevant, but it's going to be so worthwhile just keeping an eye on headlines going over the week ahead. Of course, you can keep an eye on headlines using Flux. We have a news service available on there that scours all corners of the internet and brings you up-to-date news as and when it happens. So yeah, I think headline risk is going to be, so important, whether it be for crude, whether it be for equities. That's going to be the one to keep your eye out for. So no rest for the wicked. And yeah, I hope that everyone has as stress-free a week as is feasibly possible. And yeah, by next Monday, hopefully we'll have a bit more of a consensus.
And of course, you can look at our training programs we're running on our Onyx Institute on our webpage, and you can also find them at Onyx L&D at onyxcapitalgroup.com. It's going to be a busy week. Good luck, and we'll see you next week. Thank you very much.
Thank you.
The true heartbeat of the global economy, the financial oil market, has remained out of reach for most until now. Introducing Onyx Markets, the first platform to bring personal investors into the ecosystem that sets wholesale oil prices around the world. This is where the real economics of energy begin, a market that shapes so much of our everyday lives. Onyx Markets levels the playing field. Access live, tradable numbers from the industry's leading provider of financial oil market data. Whether you're a personal investor or a global corporation, low cost, transparent, and empowering. For the first time ever, you can trade global oil benchmarks like dated Brent, Northwest Europe shipping fuel, and US Gulf Coast propane through spread betting and CFDs. Hedge with precision, trade tax efficiently, and gain unparalleled transparency. Supported by the world's largest liquidity provider in the financial oil markets, Onyx Markets also brings you insights from industry-leading analysts, detailed reporting, and expert-led education to help you navigate this market with confidence. Onyx Markets, the power of the financial oil market now in your hands. Start trading today. Visit onyxmarkets.co.uk.
Thanks for watching. If you would like to take your trading career to the next level, Onyx Institute, my online trading course, where you can learn fundamental and technical analysis of both the energy and financial markets, will be live and available for you to sign up and watch from next month. So please keep a lookout for that at onyxcapitalgroup.com. If you have any questions or queries, you can email me at onyxlnd@onyxcapitalgroup.com.